What's up guys, welcome back to the channel. Today I'm going to talk about inducement. Inducement is another liquidity concept. Inducement is usually an available liquidity in front of a POI. Institutions need that opposing liquidity to enter the market. When we don't see inducement in front of our POI, there is a possibility that that point of interest is going to fail. When we don't see price built liquidity or leave area of inducement before our point of interest, there's a possibility that that point of interest might not actually hold price. So identifying inducement is very useful. It adds more confluence to your trade. Okay, most times I wait for inducement to be swept before I enter a trade. After the lesson, I will like you to practice and implement this into your trading plan if this concept makes sense to you. One thing I need you to understand is that this applies to all time frames. You can actually identify inducement on any time frame of your choice, okay, depending on the time frames you choose and the type of trader you are. So inducements can actually be identified on different time frames, okay. The most important thing I want you to note is that inducement is a liquidity resting before a POI. That is a liquidity resting before a supply or demand zone or your order block. So I'm going to show you examples before we move to a live chart. Let me show you live example. So let's say we are in a bearish market and we see price push to the downside. We get a liquidity sweep. Now price breaks structure, pull back a little, and maybe we see a continuation to the downside. And you know, this is a liquidity sweep right here. The way I map out my valid order block, we can label here as liquidity sweep. Okay, so when you label there liquidity sweep, you're going to map out your order block right here, which is your point of interest. What I asked you to note is that inducement is liquidity resting before a POI. So this particular area right here, this can be your inducement area, and you can label here as your inducement area. Why do you label here as your inducement area? Price is going to come back, sweep this inducement, because a lot of people might be looking to sell from this particular area. Price might come, sweeps this liquidity, tap into your point of interest, and we're going to see a continuation to the downside. And what you should note is that most times you might not really get maybe one area like this. Price might actually accumulate a little here before we see price coming back to sweep this. So let me show you another example of how this might look. So let's say in another situation we see this price push to the downside, this liquidity sweep. We might not really get this liquidity sweep, but based on how I map out my valid order blocks, I have to include this right here. Okay, so price breaks structure to the downside, and we might see a little pullback right here, a very little pullback, a continuation to the downside. So the way I trade, you're gonna map out here as your order block, right? Your order block which you'll be looking to trade from. And where is your inducement area? This area right here could be your inducement area. Okay, this little retracement right here, it could be your inducement area, because some people might be looking to trade from here, you know. So some people might be looking to trade from here. So this is an inducement area. So inducement area is just an area that people might be looking to sell from, okay, a liquidity area, because inducement is part of liquidity concept. So yeah, it could be your inducement area, and some people might be looking to sell from this area. So what this does is that price might sweep this inducement sweep, that's tap into your point of interest, and a continuation to the downside. And in some cases you might see this way, might actually see price push to the downside. We see this, and we just see a clear push to the downside. Now price might try to return to that point of interest, maybe very close to our point of interest. Let me show you. You know, this is your order block which you'll be looking to trade from, and in this case you see price came very close to that point of interest and reacts without actually mitigating your zone. Maybe price reacts from a fair value gap. See, price might come very close to your point of interest and reacts this way. So this is an inducement area. Okay, a lot of people has been induced into taking trades from here. Those that do panic, maybe they think that price didn't want to mitigate this zone. Those that might jump into panic sell, okay, they might jump into selling from these areas, jumping into a trade because they feel that price is going to leave them without mitigating this particular point of interest. You see price is going to come, sweep those stops, tap into your point of interest, and we see the continuation to the downside. So this is the way inducement areas are. Like I said, inducement is a very simple concept. For me, I might say that inducement and liquidity are the same concepts. For me, they are the same concepts because these are areas where retail traders are being trapped. Okay, so why I love saying inducement before my POI is that it increases the probability of the zone playing out. It increases the probability of POIs, just like the way I explain liquidity concepts. When price builds liquidity above your zone, there's a possibility that that zone is going to hold price. You know, trading is all about probability. We add all these concepts as confluence to increase the probability of our setups. Okay, so these areas you see right here, these areas right here, a lot of people might be looking to trade from this particular area. Why? Because we have a break of structure right here. Some people might be looking to enter a trade here. Some might have placed their sell orders right here, waiting for price to mitigate this particular zone and continuation to the downside. But what you're going to see price do, price is going to push to the upside, clearing the stops at this area, mitigate this point of interest, and we see that continuation to the downside. Same thing goes to this area right here. People might be looking to sell from this area, stops above this particular area right here, but price is going to come, sweeps those stops, filling the inefficiency at these areas, then mitigates this zone and a continuation to the downside. So same thing comes here. In this particular case, price came very close, didn't actually mitigate our zone, but what we see over here is that price starts to push to the downside, and those who might panic that price didn't actually mitigate our zone and price is already moving away, they might jump into selling very early at these particular areas. Those that don't follow their plans, you understand? So price is going to come back, clear those liquidity, mitigate our zone, boom, price moves to the downside. So I'm going to show you live examples. So this is just liquidity concept like I've explained. Most mentors might explain it in a little different way, but it's essential to understand that they all mean the same thing. Okay, liquidity concepts, they mean the same thing. The institutions, they need liquidity, they need those liquidity above our POIs in order to sell or buy. You know, liquidity is what moves the market. Okay, so the institutions, they need that opposing liquidity before they will enter the market, because those areas are traps. So they're going to sweep those areas before they enter the market and they move the market. Okay, so I'll show you live examples now, and I hope you get a better understanding of what inducement means. So this is Euro USD, the 5 minutes chart, and I will use it to explain exactly what inducement is, so you have a better understanding of what inducement is and how you can actually identify inducement on the price chart. So like I explained, what you should keep in mind is that inducement is liquidity resting before a POI, or you can actually say that they are available liquidity in front of a POI. That's just the same thing. And remember what I said, after this lesson you should practice and implement it, and if it makes sense to you, you can then look to use it as a confluence. So I have to zoom in a little more so you see clearly. So from what we can see here, what we have here is that we have this break of structure right here. Okay, this is a break of structure. Price is in a downtrend. Okay, price is in a downtrend over here. So here is our point of interest. We'll be looking to trade from here. So we identify here as our point of interest. Now here is your inducement area. This area right here, you see price left this candle that was close to our point of interest. So this is your inducement area. This is a liquidity resting before this point of interest, because a lot of people might be looking to sell from this week right here. They might be looking to sell from this particular week. They might see this as a hidden zone. Okay, so this is an inducement resting before our point of interest. Now extending this particular zone, what you can actually see is that here could be another inducement area right here, because price came very close to our point of interest, reacted to the downside. Okay, you can see came close to a point of interest, reacted to the downside before we see price tapping into this point of interest. But in general, if I try to extend this line, you can see this is a build of liquidity. Price spent some time building liquidity. You see this equal highs, call it an inducement area, because a lot of people might be looking to sell from here. Now price does what? Price taps into a point of interest, and you see how price reacted to the downside. That's why I said that these concepts, they increase the probability of your zones playing out. So you can use it as a confluence to add it as a confluence, add it into your trading plan, and you're going to see a change in your trading. Okay, you're going to see a lot of change. So after that, what do we see? We have another break of structure to the downside over here. You see, this is a nice break of structure. So we go ahead, identify this as a break of structure. Now mapping out a point of interest which we could be looking to trade from. Now these are points of interest, and remember what I said, this area right here is your inducement area. Okay, this area, an opposing liquidity in front of your POI, is your inducement. So this is a liquidity area, and if you look right here, price came very close to a point of interest. Like I explained in some of the examples, price came very close to a point of interest. You see, now reacted to the downside, and what do you see? Price comes back, sweeps those inducement area, sweeps it, and you see how price pushed to the downside. You see how massive that move was. So that's simply how to identify inducements. Inducements increase the probability of our zone playing out. It's another concept of liquidity. Okay, it increases the probability of zones playing out. And if I continue to explain, what can you actually see right here? What you can see is that we have this break of structure to the downside, and understanding market structure is very essential in this smart money concept. Understand market structure. So you see price breaking structures to the downside, making you understand how to select your points of interest. You see that the points of interest we've been selecting are valid POIs, because the way I select my valid POI, you see we have a sweep of liquidity right here. Okay, this is a sweep of liquidity, so it's a valid POI for me. You see over here, price sweeps the liquidity at this high, so it's a valid POI for me. And if you don't know how to identify valid POIs, I'm gonna link the video in description after now, so you can check it out, how I map out my valid points of interest. So you see we have another sweep of liquidity right here. So these zones I'm picking are my valid POIs. They are the kind of zones I like trading from. Okay, so this is another sweep of liquidity, and we have price pushing to the downside, breaking structure to the downside. So mapping out my points of interest, this is the zone I'll be looking to trade from. Now, where is my inducement area? This is an inducement area because at first, what do we see? We see price trying to break structure. We have this pullback, and now we get a break of structure. Now, a lot of traders will be looking to trade from this zone right here. Here looks like a very good sell zone. Yes, a lot of people might be looking to sell from here, but what you're going to see price do is that price is going to sweep this area, and you see we have another inducement area right here. So let me label it. Here is another inducement area, which point you might make mistakes and you might fall for this trap. But the essence of this video is so you understand it and try to avoid those mistakes. Okay, so once you understand this, there's a possibility that you might avoid making the mistakes and you take right decisions while selecting your zones and choosing the kind of point of interest to trade from. Okay, so that's why we explain this stuff, so you understand how to do it the right way. So after here, what do we see? Price mitigates the zone, push to the downside, but we didn't actually see price breaking to the downside. But for the purpose of this video, I'm going to explain the internal structure and explain what happened right here, so you understand more about this inducement. Okay, so from here, reading the internal structure, okay, don't mind me, I'm going to explain about the internal structure. So what we can actually see from here is that this is a break of structure, that is price breaking the internal structure. Okay, and where is our point of interest? We have this point of interest right here, which we'll be trading from. This is a very good point of interest. And now, where is your inducement area? At first, this is an inducement area because a lot of people might be looking to buy from there. Okay, this is an inducement area, and price kept pushing to the downside. So you can actually say that this low right here is equally an inducement area. Okay, it's an inducement area opposing liquidity before the point of interest. Keep that in mind. And after that, what do we see? Price taps into the zone, and you see the reaction to the upside. Price reacts to the upside, and what can we actually see right here? You see price pushing to the upside. So if I continue to explain about the internal structure, what you can actually see, why price was moving to the upside, we have this break of structure right here, and we equally have this break of structure right here. So if you want to read the internal structure, what you can see is that we have this point of interest right here, and we have our inducement area. So this is our inducement area. The second example I showed when I was explaining earlier with the sketch, this is that type of inducement where you see price give a little reaction, more like a little pullback and a continuation to the upside. So that's an inducement area for me. Now, choosing my point of interest, this is my point of interest, this candle right here, because this candle swept the liquidity at these lows. If you look closely, you can see we have these relative equal lows right here. Price sweeps the liquidity at that low, and here's my inducement area, high probability point of interest for me. And if I try to extend this, you can see this looks like a liquidity area, because it seems like an equal lows. What do we see? Price comes back, mitigates this point of interest, and we see the reaction to the upside. So this is all you need to understand about inducement. It's very, very important, and once you understand this concept, I'm telling you the truth, you're going to avoid most of these smart money traps. I've talked about liquidity, inducements. These are smart money traps, areas you can look to avoid trading from. Okay, so I think I should show you one more example before I end this video. So these are the second example I'll be using to explain this, and these particular two examples were trades I actually took earlier this year. This was during February, and this particular one I took it on March. So I'll explain these two examples and I'm gonna end the video. Okay, I'm gonna end the video. So what can we actually see right here? What you can see is that we have a very clean price action right here, a very clean price action. So at first, what did I see? I see price form this accumulation right here, because this was like an accumulation over here. Now price pushed to the upside after it must have swept this liquidity, more like accumulation, manipulation and distribution. Okay, that concept, based on that concept. And when price pushed to the upside, I identified here as my inducement area, even though I didn't label it, but I had it in mind that this is an inducement area and this could possibly be another inducement area. And after that, what do we see? Price returning back to my points of interest, came very close to my points of interest, and this reaction to the upside. Then I actually identified this as another inducement area which I'll be expecting price to sweep before tapping into my points of interest. But finally, what we saw price do, price accumulated for a very long time. You see price spent time accumulating right here, and after that, what do we see? Price taps into this point of interest and you see the reaction. So understanding the concept of inducement and liquidity is very essential as a smart money trader. At first, what do we see? An inducement area. Secondly, price induce people into taking more trades from here, builds more liquidity for smart money. And after that, what do we see? Price sweeps it after it must have swept the liquidity at this particular lows. And what do we see after that? Price expands to the upside. Okay, you can see the massive reaction to the upside. Price moves to the upside, and this particular trade, I didn't actually wait for price to hit this target. I took my profits very early. I usually go for 1:4, and because I was in a losing streak that period, so I had to take my profit on time. Okay, so this is the second example right here. Before I round up, what we can see over here is that we have another clean setup over here. What we actually saw is that price sweeps the liquidity at this low, a very good trading style which I love and I teach. Okay, so see price sweeps the liquidity at this low. You see that expansion to the upside, price leaving this imbalance right here that needs to be filled. What you can actually see is that this is our inducement area, and after that, what do we see? Price accumulates, building more liquidity above my zone, because this is the kind of things I love seeing when I talk about high probability setups. This is what I mean. Price builds liquidity above my zone, and this is inducement area for me. You can call it a liquidity zone, smart money trap, or an inducement area, because a lot of people might be looking to trade from this particular area. That's why you see me map out these points of interest. Usually what I do is I used to label it red, so you know that this is an inducement area. Okay, so I usually label it red. I have to make it very thick, so you know that this is a danger zone. Okay, this is a danger zone. So price comes back, mitigate it. You see the little reaction, and finally what the price do, you see how price sweeps those liquidity, those stops at this area. Price takes them all, tap into this point of interest, and you see how price reacted, pushing to the upside. So these are simple concepts, and I hope you understand exactly what I explained in today's video. So what I want you to do right now is to go back to your price chart and backtest all this. After each of my teachings and lessons, I usually advise you guys to go back to your price charts, backtest what you've learned, and try to implement into your trading style. I'm telling you the truth. Liquidity concept, inducement concept, they're very good concepts that can actually increase your win rates. That's the truth. It can increase your win rate. So that's what I want you to do. Go back to your price chart, backtest, and be the best trader you can. Okay, be the best trader you can. So if you're new to the channel or you're watching me and you've not subscribed yet, consider subscribing to the channel, and see you in the next video.